point and destination. What's the difference here?
Shipping point, the title transfer is when it's like at the person that's shipping it.
Yeah.
And destination is when it arrives.
If you're shipping it out and you ship it, right, as soon as it leaves you, who does it belong to? The buyer. That's when you record the sale, and that's when you eliminate the inventory, and of course record the cost of goods sold. Right, guys? That's it. Okay? If you're buying something and it's FOB shipping point, though, what is it? As soon as they ship it to you, it's yours. In the truck, it's yours. So keep these straight. Just let you relax and think about it, but they're obviously opposite if you're buying something versus selling something. Does that make sense? What's FOB destination mean? It's the opposite, right? It's your inventory until it gets delivered. So as long as it's on the truck, it's your problem, right? It's still yours. It's in your inventory. You don't record the sale until it gets delivered. It's when title transfers. That's what it's about, right? Okay, legal title. Who pays the freight? If it's FOB destination and I'm selling it, I'll have to pay for it, right? If it's FOB destination and I'm buying it, I don't have to pay the freight. Got the idea? Okay, so who pays the freight? Who insures it? Who takes the loss if it gets damaged? Right, guys? Okay, so the decisions are really critical in terms of that, okay? And they'll ask you about that. Consigned goods. You could have consigned in and consigned out. You guys ever been in a Hallmark store? They don't own most of that stuff. All the trinkets, you know, the lighthouses my wife buys and all that crap. Okay, all those things that are in there, the Hallmark store doesn't own them. They're there on consignment. They belong to whoever produced the goods, right? What happens? As soon as Hallmark sells it to you, right, they record the sale and the purchase simultaneously, right? And the cost of goods sold. The purchase and the cost of goods sold right at the same time. They don't take title to it until they sell it. If they never sell it, they're going to give it back to whoever produced the goods. That makes sense? Lots of businesses operate that way. Okay, so if goods are consigned out, it's still my inventory, right? If I have goods out all over the place. So I'm a company, you know, that sells through Hallmark stores. And I got them in every Hallmark store in the world, maybe, right? Maybe not. But anyway, I send them out to them, right? All that stuff's my inventory. Is it kind of hard to count this inventory, seeing as it's not with you? Right? When Hallmark counts their inventory, though, they have to segregate all that stuff and not include it. Make sense? That's all it is. Yeah.
I was going to say, what would you record for Hallmark when they sell like a consigned good? It would be like a revenue.
They would debit cash or accounts receivable and credit sales. Cash in their case, and credit sales.
But they wouldn't have.
And they would debit cost of goods sold, right? And credit payable to you. Basically,
That's what the cost is. The payable is the cost.
Yeah, but and so you know if they sell something for $100, the cost of 40, right? They debit cash for 100, credit sales for 100, and then they debit either purchases, right, or cost of goods sold, either way, for the 40, right? Credit payable to whoever they're buying it from, or credit cash if they're wired from, right? Yeah, I mean it's just instantaneous. And you know what? There's lots and lots of inventory that is over here at UPS and warehouses all around the world. We're a big logistics center for UPS, right? And yeah, for FedEx too, they have a lot of facilities here. And what happens is companies that are independent of the person that produced the goods and independent from the customer that's buying the goods is holding them. They're holding the inventory. That's all just like the second inventory. Does that make sense? It belongs to whoever produced it, right? Because UPS isn't buying that stuff. Have you ever bought anything on Amazon.com and it gets delivered, you know, same day or the next day? It's already in Louisville, you guys. They didn't ship it here, right, that fast. Okay? Even that's a bit much. So we've actually had things show up in the afternoon. My wife bought them more. Yeah, So certainly the next day is real common. And we're not paying next day freight. We're paying no freight on it, right? We're willing to wait the 7 to 10 days. Well, of course, it doesn't take that long. It's the warehouses right here. Okay? They have good systems. Okay, so that's consigned. Sales with buybacks. If you have an agreement that you're going to buy it back, you didn't sell it. What do you think? So you don't record the sale, and you don't record the cost of goods sold, and you keep the inventory on your books. Okay? So with the right of return, it's the same thing. Okay? So if they've got the right to return it, high rates of returns. Now my wife buys all kinds of stuff from Nordstrom. She really likes Nordstrom. And one of the things she likes about them is if she doesn't like something when they deliver it to her, she can send it back to them. no questions asked. They got famous this way. They used to be a shoe store when they started, and you could return shoes whenever you wanted, and there were actually stories of people wearing shoes out and then returning them, and they would actually take them back and give them another pair. But that's how they built their reputation. Most, of course, honest people don't do that, right? You usually, you wouldn't return it. But if anything you don't like, you can return. Now, does that mean they can't record a sale? For, they're sending thousands of things to people, right? And people are taking things out of their stores too. They have big stores, just like Macy's or somebody, right? So, they're taking stuff out of their stores too. They go ahead and record the sale, but what do you have to do? You estimate, right?
Sales returns.
You estimate sales returns, and you make a journal entry. Debit what?
Sales returns.
Well, that's going to be what? The sale is a credit, so sales returns and allowances is going to be a debit. You debit sales returns and allowances, which is a contra revenue account. But what are you going to credit? It's just like allowance for doubtful accounts, only it's allowance for sales returns and allowances. Allowance for sales returns and allowances. Okay, but that's what it is. That makes sense, guys? Okay, so as long as you can estimate it, you're okay. But what do they say here? I can't estimate it. I don't know how much it's coming back. So I'll wait to record the sale, and therefore wait to record the cost of goods sold. I'll keep the inventory as my inventory, even though I deliver to the customer. Got it? So what's happening here? Sales on installments. They're going to make installment payments. You'll have a sale if they're going to make installment payments? Maybe. If you're sure that they're going to pay you, pretty sure, it's probable, right? Definition of asset. Probable is enough, right? Okay? If it's probable they're going to pay you, then you can record the sale. But what if you're not sure? The reason you sold it on installment is because they don't have cash, right? So what might you do? Record the sale as they pay you. So let's say they're making 4 payments, spread over 4 quarters, say every 3 months. Each payment we would record 1/4 of the revenue, right? 1/4 of the sale, and we would record 1/4 of the cost of goods sold at the same time. You guys do realize that when you debit cost of goods sold, you credit inventory, right? So it's still your inventory until you debit cost of goods sold, right? Everybody good? So you can just think about it in those terms. So, on any of these. That's what is going on. All right, this one's really big. Effective heirs on inventory. Can you do this stuff? I'm going to try an example. Maybe be worthwhile. So, let's try. Pull this thing up. Let me give you an example. Okay. Beginning of year. Beginning. income year after year after year, what do you think their beta look like? Real low, low risk company. Everybody agree? Income's like increase, continuing, going up, real stable, Okay, tell me what the net income should really be. Corrected net income. This is a real common question. Did you do it? Correct net income. So reported net income is 300, 310, 320, 330. What's correct? What would you do with this? By the way, why did I not give you beginning inventories for all those other years? Yeah, the ending of the prior year is the beginning of the next, of course, right? Everybody agree? Relax. I'll give it to you. Of course it won't. Anything I still have in inventory is not in cost of goods sold, right? Anything in cost of goods sold is no longer in inventory. Set up a little cost of goods sold schedule, right? Figure what the over or understatement would do with the cost of goods sold. The beginning and the ending inventories have the opposite effect, right? Because you add the beginning and you subtract the ending, don't you? Okay. We're doing a little problem. When we tell us to correct the net income, this is inventory, beginning, and ending. Okay. What we're doing is we're looking at what's the effect for errors. Not a big deal. Just pain. I bet you looking at those net incomes as reported that they were smoothing their income by misstating inventory on purpose, if I saw this. That's one hell of a coincidence, right? Those incomes aren't even close, right? If you ran across this, if you're an auditor, you'd go, oh my gosh, this is ugly. Probably intentionally misstating their financial statements to keep their beta down. Keep your beta down, what happens to your cost of capital? It goes down, which means what? You borrow money, cheaper. You issue stock, sell for more. So would people be interested in smoothing income? Right? Okay. So we always watch for those points. Income's too stable to really. I've had clients that didn't want to give me, small clients, we're not doing an audit, we're doing a review, but they didn't want to give me the ending inventory until they had seen all my journal entries I came up with. So then they determine what their inventory should be based on what they want their net income to be. You know what I do? I keep in my desk stack that they didn't know about of all the journal entries that reduced their income. I give them all the journal entries that increased it. Break them of it, right? Because then as soon as they give me the inventory, I give them all the journal entries that would reduce their income. And they go crazy. Oh, no, my inventory's wrong. Nah, you gave it to me. I like the number. It's just mine. Let's keep it. And then you find out what was really going on. You did it, admit it. Well, I'm just estimating the inventory anyway. No, you're not. You're counting it, damn it. And we go count it. In a review, you don't audit it. You don't watch them do it, right? Trust them. You guys got numbers yet? What do you do? I think on my income statement, I have what? Sales less cost of goods sold. How do I calculate cost of goods sold? Beginning inventory plus my purchases. By the way, we could screw around with purchases too, couldn't we? And they will on the CPA exam. And freight in has to go in there, and purchase discounts. And so they can make it complex if they want, but it's the same idea. This is available, right, guys? You subtract the ending inventory, and that gives me what? That is the cost of goods sold. You take cost of goods sold away from the sales, and what do you have? Gross profit. And that gross profit, how far off that is, because operating expenses is okay too, right? Taxes, well, taxes will be wrong too. We won't worry about that. Okay? So whatever's wrong with gross profit is what's wrong with net income. Do you agree it's overstated or understated? Yeah. So once you got that, you can adjust, can't you? So if we assume this is okay, and we assume this is okay, all I really have to know is cost of goods sold too high or too low, right? Let's do the first one. Beginning inventory is understated. If this is understated by 100, what does that do to available? It makes it be understated by 100, doesn't it? Okay, what would that do to cost of goods sold? Well, if ending inventory was okay, cost of goods sold would be understated by 100. Is that right? Which would make gross profit, net income overstated by 100 for that one error. Everybody agree? And then the 50,000 error, what does it do? If this is overstated by 50, I subtract 50 too much. What is that going to do? That's also going to understate my cost of goods sold, right? And it's going to overstate my income by 50. You can do it just like that. It's really easy. It's 150. So I should have 150 more income. Would you guys agree with that? So this first year they made 450,000, not 300,000. True?
I thought it was the opposite. I thought it was overstating income.
Oh, they overstated income. I'm lying. Reduced the beginning inventory is understated. It's too low, so it should be higher, which would make available higher. I wrote it backwards, didn't I? Is that I'm right? Wrote it backwards or something? Understatement would make beginning inventory too low, would make available too low. No, that's right. Which would make cost of goods sold too low and gross profit too high. That's right. Income's too high. And the same with the 50, right? So it's 150, the income's too high. I'm sorry. So what do we have here?
150 actual.
Big mistakes, huh? What happens the second year? So that's 2012. Just keep going. What's the trick, though, guys? This beginning inventory, right, in the second year is what?
Overstated.
Ending from the first one, right?
Yep.
So it's going to be overstated by 50, which is going to make, and if purchases are fine, right? What do we have for available? Overstated by 50. What's that going to do to my cost of goods sold? Make it too high by 50. What's that going to do to my gross profit? Make it too low by 50. That's all you got to do. And then keep going. What happens to what happens at the end of the year? Overstated by 75. So if I subtract 75 too much, what happens here? Now you're subtracting too much, which is going to make cost of goods sold too low, right? By 75. And that'll make net income more by 75. So what's the net effect on net income? It's too high by what? 25 this time, right? 50 offsetting the 25, right? 50 too low and then 75 too high, right? So I've got 25 too much income in there, so what should it be? 285, is that right? So both of those are overstated? Okay. We go to 2014. So I guess they had really horrible years and they wanted to fix them, or at least the first one was horrible. Okay, what's this one going to be? Beginning inventory is what?
Overstated by 75.
Okay, it's too high by 75, and that's going to flow right down, make available too high by 75, right? Which is going to do what? Make my cost of goods sold too high by 75. Everybody agree? Okay, which is going to make my gross profit too low by 75. Is that true? Notice each one of these is just reversing themselves, right? See that across there? Okay. It corrects itself the next year, doesn't it? Okay? So then what?
Ending inventory is understated by 80.
Okay, ending inventory is too low by 80, so we got to do that one. If this one is too low by 80,
Cost of goods sold higher.
you're subtracting, right, too small a number, which then gives you too much cost of goods sold. So this one's going to be 80 plus 75, isn't it? So how much are we off on this one?
155.
155, but what's it going to do? It makes my net income more, right? So this company has very erratic net incomes, okay? A ridiculous example here. So 155 added to 320 is 475, is that right? It's 155, wasn't it? Okay. inventory is understated by 80, right? It's going to make available be what? Understated by 80. What's that going to do to cost of goods sold? It's going to make it too high by 80, right? I'm sorry, too low by 80. Okay, and we just do the next one. Okay, it's okay, isn't it? So what's going to happen to us?
Net income should be 80,000 higher.
Too high. Okay.
Too low.
Let's see. We're going to reduce cut. If our beginning inventory is too low, then our net income's too high. Yeah. Okay. So how much is that going to be? 250. We go the right direction. Offset the 80 too low by make it too high. Yeah. Okay. What do all those add up to? And what do all these add up to? Kind of interesting when you look at it. Boy, it looks stable. What does it come up to? 100 difference? This is 1,200 and yeah, 1,260. Is that what this is? How much is this? Huh. It didn't quite clear it all, did it? Why not? Because I had an error at the beginning. If that had been nowhere at the beginning, it would have been exactly the same number, huh? Just allocating between years. But I was 100 off on the beginning, right? So the year before that was wrong too, wasn't it? Right? Or previous years. Okay? So can you do something like this? No big deal? These are real common. Real common on CPA exam. Therefore, real common on my exams. But remember, we can mess with purchases too if you want instead. It has the same impact, right? Okay? Do whatever it is. Okay, good. All right, so, and that's what they're doing here. You can take a look at these two. The effect of an error on net income in 1 year will be counterbalanced in the next. However, the income statement will be misstated for both years. Okay? So this is a real common way of smoothing income. That's pretty good.
We need to know like the effects on like working capital and current ratio and stuff like that.
Well, sure.
It's like, I mean, if you know like not the ratios, but you know like how it affects like liabilities and assets and stuff.
Then you got to make it. Yeah, that's all it is. If you change your current assets or current liabilities, you change your working capital. Change either one or both. If you change either one of those, you also change your current ratio, right? Makes sense. And you might change your quick ratio that way. They can use any ratio they want. Just those already know them all. So yes, that's fair game. And they're showing you exactly what we just did, right? So you might want to take a few minutes and go through these. Let's see. And you could also misstate purchases, right? You mentioned that, and here's the working capital current ratio thing you were talking about. So you might want to read through those. It should just be you could just figure it out. Huh? Do you understand what a product cost is versus a period cost? What do you mean by product cost? Costs become part of the product. What are period costs? Cost you expense during the period. That's it, right? You either use them up during the period and you match them, right? The cost of the revenues. Or what? Remember this from before? Their cost that you're apportioning over time, amortization, depreciation. Right, guys? Okay. So costs, generally selling general administrative expenses would be the period costs, huh? And then product costs are what? Materials, labor, and overhead that go into making a product that you're manufacturing. You buy the product from somebody else, the costs that go in. But what about taxes on buying a product? If I have to pay import tax or excise tax or you name it, part of the product cost. What about freight in? Part of the product cost. What about freight out? That's a period cost because it's a cost of distributing my product, right? Delivering to the customer. Is all this just becoming common sense? What would you do with purchase discounts? That's a reduction of the product cost, right? If the discount happens to be on inventory, right? Okay, and a discount on anything that's a period cost, usually selling general administrative expenses, but it could be research and development expenses too, right? What would all that stuff be? Well, if you have discounts on those, that's a period cost, huh? So it's just something. What's the gross versus the net method? We did that in the receivables, did sales. This works exactly the same way. gross amount, or you record it at the net that you're gonna pay. What is more common on purchases? Seeing as we always take our discounts and do the net. What's more common on sales, seeing as we don't know whether our customer's gonna take the discounts or not? Gross is more common. So you'll see them opposites, right, within the same company. It's real common, no big deal. So take a look at that. Maybe I'll get really generous and give you a question like that. That'd be fun, wouldn't it? So they show an example. I don't want to go through that again because it's exactly the mirror image of the sales side. Okay? This is what you save, unlike this one. Specific identification or FIFO, LIFO average, we had a little problem last time on that. Cost flow assumption adopted does not need to be consistent with the physical movement of goods. No kidding, right? It won't be, unless what?
Specific
identification. Okay. That's the only way to do it. Method adopted should be one that most clearly reflects periodic income. Really? Is that what we do? Yeah. What we do is we use LIFO for the tax return, and then we kind of pretend to use LIFO for financial statements. What do I mean by that? We use a LIFO reserve to tell people what LIFO income would have been. So we don't technically use FIFO for financial statements, but we end up with the same effect as if we did. This is crazy. We really need to get rid of LIFO. Just use it for tax purposes. What would happen if you use LIFO for tax purposes and FIFO for book purposes? You would have deferred income tax to the extent that your inventory is different. That's all it is. It's not a very big deal. Why don't we change that? I don't know. I don't know why Congress really fights it. Companies don't like it. They're afraid they're going to give up what? LIFO for tax purposes. Afraid they would repeal that. What would the administration always like to do? Seems they're always interested in raising tax dollars. Congress would be fine with it too if they thought you could get away with it, right? Nobody's noticed they really raised the taxes. Of course, companies are going to be aware, right? Billions of dollars in taxes right about it. Huge. How much could be collected? So maybe they're afraid if they allow you to use a different method for book purposes than you do for tax purposes, that somehow they'll lose their LIFO tax savings. Don't have to do that. Administration, of course, wants to collect the taxes, right? So every administration pushes for it, and they all lose. Okay, so far. Okay, anyway. We did these. Yeah, we looked at them. They're lovely. Easy. Yeah, here we go. Okay. Special issues related to life. Should know this. Should be able to write an essay about this kind of stuff. Advantages, better matching. These are the arguments you use. What do we mean better matching? Revenues, expenses, cost of goods sold is better matching for revenues. Why? We are using more recent costs. They're more representative of replacement costs. That's it. Okay? That's true. Another advantage, tax benefits improve cash flow. Tax benefits, as you save tax dollars with LIFO. Assuming what, guys? What must be happening to your costs? Inflation. Going up. There's inflation. If there's deflation, the reverse would be true, right? You can get caught in that box too. Once you adopt LIFO, rather, can you unadopt it? Not without the IRS's permission. Sometimes they get it, sometimes they don't. I've actually seen these things where we wrote it and done them. We write a letter to the IRS explaining why we're going to switch. It can't be to save tax dollars, right? It can't be because, oh, my costs are starting to go down, I didn't want to save taxes. It can't be that reason, so you come up with reasons. Some of them you might use. How do you get improved cash flow out of it? You don't pay as much taxes. That's improved cash flow. That's it. Okay, big deal. Future earnings hedge. What is it? Smoothing income? It is, isn't it? Right? I'm going to make more it's gonna look like I'm making more than I am later. I don't like that one, but I guess that's true, right? Kind of, I'm showing less income now, I'm gonna get to show more income later when I deplete the inventory. Okay, so disadvantages, reduced earnings, inventory understated, probably. You know what? You close the accounts on the income statement. Cost of goods sold gets closed, right? Or purchases, depending on which method you're using. When do you use purchases? We didn't have this from you last time. Periodic. When do you use cost of goods sold? Perpetual, right? Yeah, so either one of those would be closed every year, right? So any error that's in them goes away and goes into retained earnings. Would you agree with that? You start over. What happens with inventory, though? It's a real or permanent account. You never close it, right, guys? So seeing as you don't close that, what happens with an error that's in it? It stays there, and then the next year you add to it, the next year you add to it. Imagine what happens year after year after year. When we were doing the LIFO problem, the one we did last time, that inventory is a lot less under LIFO, and it's progressively worse year after year after year after year after year with inflation. Got the idea? So we're screwing up our balance sheet big time. So that inventory understated is a really big problem. The physical flow of the goods is more likely to be FIFO than LIFO, right? Let's hope so. Okay, you're selling the old stuff first. And then involuntary liquidation and poor buying habits. What do I mean by that? I might actually have to reduce my inventory. I might not be able to replace it. And what's going to happen to me during that period? I'll have sold cheap ones and I'll make a whole bunch of money when I didn't intend to. So it's not really making money. It's just like on my tax return, I'll maybe showing more profits, right? So you could have involuntary liquidation. Poor buying habits, what would that be? I buy inventory that I don't need to make sure I don't deplete my inventories, right? My sales are going down, but I don't want that inventory to go down. It's ridiculous. When just in time came in, what's just in time? I have a great relationships with my suppliers where they do what? They get it to me just in time for me to sell it to my customer. What happens to my inventory levels? The Japanese are really good with this. It's a real competitive advantage. It goes way down. You get your inventory completely gone. What does using UPS do for your inventories? You can ship it all same day. The inventories would be much smaller, right? So with the explosion of air freight over the last few years, what's happened is inventories are shrinking. What happens to your LIFO and your inventories are shrinking? Uh-oh. Right? You've got this liquidation. So what would the poor buying habit do? Keep inventory you don't really need. Keep your inventory large so you don't have to pay taxes. This doesn't make sense, does it? It might economically, right? But it doesn't make sense for the economy as a whole. I mean, for saving taxes, it might make sense. But for the economy as a whole, it's kind of ridiculous. And for long term for the company, it doesn't make any sense. Okay, so you look at that. All right. Reasons to reject LIFO, you're not going to get any tax benefits, right? You don't have to make a tax payment. Prices are declining. Rapid inventory turnover wouldn't make any difference, right? The inventory is immaterial, okay? Other costs, regulatory or other restrictions, excessive costs, high administrative costs, LIFO liquidation related costs, and other adverse consequences, lower reported earnings. If I report lower earnings in my financial statements, right, that might affect my stock price, right, guys? So you know what happens in closely held companies? They're more apt to use LIFO. Publicly held companies, they might opt to use LIFO to make their reported earnings more. But that's not logical either, because then they have to pay more taxes. Isn't the idea? So it's good that we have this LIFO reserve that we can use now. Okay, and it's just bad accounting in general. Okay, so reasons why companies reject LIFO. How would you select? LIFO is generally preferred if you're going to do what? Save taxes. That's it, right? Selling prices and revenues are increasing faster than costs. If a company has a fairly constant base stock, your inventory is not going way up and way down. Okay? Stays constant. All right. LIFO is not appropriate where prices tend to lag behind costs. You have deflation is all it is. If specific identification is traditionally used, okay, so costs are decreasing as production increases, that sort of thing. So be careful with it. To comply with the LIFO usually results in an immediate tax benefit, so we do it. Concern about reduced income resulting from adoption of LIFO has even less substance because now the IRS has relaxed the LIFO conformity rule, okay? So you technically have to use it, LIFO, for both financial statement purposes and tax return, but you can get around it with this. That's the point. So, oh shoot, it's not there. Let's take a look at the chapter. Either that or right up by. Let's take a look at that LIFO. Next chapter. There you go. There's the LIFO approach here. Anybody recall seeing in this chapter the LIFO allowance?
With LIFO reserve.
Yeah, LIFO reserve.
Yes.
It's in this chapter. I don't know why I didn't find it in this PowerPoint.
Got it.
Page
Highlighted.
452.
Which cost flow assumption?
It says 430.
432.
Yeah.
They don't do much with it, but they did
Yeah,
show
they
it.
really didn't LIFO.
There it is. Okay, the LIFO reserves. That's it, on top of page 433. They didn't do much with this. We had to talk about it though, because everybody's using it, right? So what we're doing is we're adopting LIFO for tax and external reporting purposes. However, you maintain a FIFO average cost or standard system for internal reporting purposes. How do you want to make your pricing decisions? Based on FIFO costs or LIFO costs? How do you want to make your pricing decisions? Probably based on FIFO or some average or something, right? Certainly not LIFO, or you're not going to be competitive probably, huh? Okay, it's probably not going to work. So, do you really, and how do you want to run your company? Are you really making the income that is implied by LIFO, or are you making the income that's implied more by FIFO or by specific identification? Certainly FIFO, right? And it's how you manage your inventory. So, how do you want to do this? Probably you want to use FIFO for internal purposes anyway. So what they do is that the companies will base their pricing decisions on FIFO or average or standard cost rather than LIFO. Record keeping, they'll also keep on FIFO, and then what they'll do is they'll set up a LIFO reserve. And how is that thing working? You estimate what inventory would have been if you were using LIFO, right? So what happens? Take a look at the top of page 433. Assume that Acme Boot Company uses the FIFO method for internal reporting and LIFO for external. On January 1st, 2014, they have an allowance to reduce the inventory to LIFO of $20,000. How would you show that in your financial statements? I'm going to have my inventory kept at what? I'm keeping it at FIFO, but I want to put LIFO on the financial statements. So what do? What would I have? Probably show, what am I going to do on my balance sheet and on the income statement? What is going on? inventory, which is kept how? At FIFO? And then what do I do? Less LIFO reserve. Okay, so what I'd end up with then is my inventory at LIFO, right? And assuming that there's inflation, LIFO is less, right, guys? So this would be a less. If there's deflation, you go the other way, right?
So
Yeah.
is this a contra asset or?
Yeah. Exactly. Okay. So what they say, this is 20,000. If this is 180, say, I'd be subtracting that 20, and I get LIFO of 160. Does that make sense? That's all they're doing. Okay. And this account is exactly that. It's a contra asset. It's just going to sit there, and over time, you're going to have that account, the LIFO reserve, getting bigger and bigger and bigger, probably, right? And what it represents, so we just keep adding to it year after year after year, and you've got now at this point in their example, you got 20 in there, huh? It's all it represents is the difference between your inventory at FIFO and your inventory at LIFO, okay? So what hits the income statement, though? When you think about cost of goods sold, when you calculate cost of goods sold, what you want on cost of goods sold is what cost of goods sold would be using LIFO, right? But you want to be able to tell people what it would have been with FIFO. So here what we get is a cost of goods sold at FIFO, but then we adjust it by what? This is the trick. It's the change in the LIFO reserve. Just the change. And a real common mistake with this, of course, when you look at it, is that you're going to either add or subtract the change, right? If the LIFO reserve goes up, you're going to have more of a debit here, right? So your cost of goods sold at LIFO will tend to be more. So usually this will be added. With inflation, you'll be adding because this number is getting bigger, right? Okay? So to continue that problem that they have there, what they say the balance is at the end of the year in the LIFO reserve? It's 20 at the beginning, what they want it to be at the end. What does this go? It should be 50,000 at the end of the year, right? Starts at 20, should be 50 at the end. Okay? Fine. How would you make that 50? How do they get that journal entry? Right? Put 30 more in, right? Credit the allowance, right? Credit the LIFO reserve allowance. Increasing it by their 30,000. Everybody see that? No big deal. Don't do it for the 50. You've already got 20 in it. What's the real common mistake people make? They'll credit it for 50 because you want a LIFO reserve of 50. Well, you only want to change it from wherever it is now, like any contra account, right? Any asset, liability, equity account. You're going to be adjusting from where it is to where you want it to be. You don't close this thing, right? That's the whole point. So I don't think they're very clear about that. And what would this debit be? More cost of goods sold. So the cost of goods sold I'm going to show would be, in our case, 30 more because I'd add 30 to this. So whatever cost of goods sold was before doing this, maybe cost of goods sold is, I don't know, if we got 180 inventory, maybe this is 500. This will make it 530, okay? In our little example. That's 30 would come in here, right? And this wouldn't be 20. In this year, what would it be? 50 for the new year. So at that point, if I have 180, this would have been only 110. You got the idea? Okay? So it's kind of moving target. How could somebody convert to what the financial statements would have been? With this information on the face of the balance sheet, you've got this on the face of the balance sheet. On the income statement, you probably just have this cost of goods sold number. Yeah. Oh, it's 130. I'm sorry. Sorry about that.
Maybe I'm.
Yeah, I did something wrong. Yeah. Okay. Yeah, thank you. how could you convert this? You've got this information on the face of the balance sheet, right? Or at least in the notes, right? You'd have this information in the notes, what inventory is at FIFO, and then you could tell them what your LIFO, well, you wouldn't even have to tell them what your LIFO reserve is, this is what would be on the balance sheet, right? You tell them what it would have been at FIFO. If you want, you can tell them what cost of goods sold would have been under FIFO too, but you don't have to. You can convert really easily, because your comparative statements going year after year after year. What could you do, guys? Adjust cost of goods sold for the change in the reserve every year. So here's the deal. I can use LIFO for my tax return, right? And I can use FIFO for my financial statements. So it's a very easy adjustment. And that's what they mean. The financial statement user has to make the adjustment, right? I'm still going to show my net income, the cost of goods sold, my net income based on LIFO. I'm still going to show my inventory based on LIFO, but I'm going to give them all the information they need with this reserve to make a conversion. What do you think? Every single analyst who knows what they're doing does. They convert LIFO to FIFO. So you can compare FIFO companies to LIFO companies, right? We got rid of this difference. So we're kind of pretending we're following the IRS law. That's what I mean by relaxed. We're giving you enough information to make a conversion, but the law is kind of silly anyway, isn't it? So, anyway, got it? Easy? No? Anyway, that's maybe the most confusing thing in the chapter. Anyway, and at the bottom of 433, they show, in the middle of the page, they talk about how they're doing it, right? Look at American Maize. At December 31st, 31,560,000 inventory value using LIFO. This amount is less than the corresponding replacement by 3765, or 3,765,000. You could immediately adjust it, right? Okay. Brown Shoe Company, they show the inventories and say, in the note, inventories are valued at lower cost or market, principally by LIFO. If FIFO had been used, inventories would have been higher, resulting in a higher, and in the current year, inventories would have been higher in the current year and so much higher in the previous years. Can you adjust income for that? Yeah. All it is debit inventory and credit cost of goods sold, right? Everybody good? And then what the numbers mean, comparing apples to apples. All you have to do is take, for your inventory adjustments, take LIFO, right, plus the LIFO reserve equals the FIFO inventory year after year. Anyway, see you guys. At 3, huh? Come with questions.
Wait, is it 2 to 3 or 3 to 5?
3 to 5. We're going to do 3 to